What if I told you a boring $10,000 investment could quietly turn into hundreds of thousands without trading, crypto, or stress? Most people think building real wealth requires staring at charts for 8 hours a day or finding the next viral meme coin before it pumps. But the truth is much simpler and far more reliable. Today we are diving into a strategy that uses the power of the 4 best Fidelity index funds to create a wealth building machine that runs on autopilot. We are going to look at the exact numbers, the specific funds, and how a one-time investment of $10,000 can evolve over the next few decades. This is a simple 4-fund setup that anyone can copy, regardless of their experience level. But there is a catch. Even with the perfect portfolio, one specific mistake could destroy the entire strategy and leave you with nothing but missed opportunities. I will show you exactly what that mistake is at the end of this video, so make sure you stay tuned. When it comes to building a portfolio, the platform you choose matters just as much as the assets you buy. Fidelity has established itself as a titan in the industry, and for good reason. They are known for having some of the lowest fees in the business, including their famous zero expense ratio funds. When you are investing for the long term, every fraction of a percentage point you pay in fees is money taken out of your future pocket. Fidelity provides a trusted, long-standing platform that makes professional-grade investing accessible to everyone. The reality is that index funds consistently beat most active investors over long periods. While people are out there trying to time the market or pick individual winning stocks, index fund investors are simply buying the entire market. What people think makes money is high-speed trading and complex strategies, but what actually works is the patient, boring process of capturing market returns through diversification. This is a set and forget system, not a second job. For our $10,000 experiment, we need to establish some ground rules. We are assuming a one-time $10,000 investment with a long-term horizon of 10 to 30 years. We are not timing the market, and we are not adding more money in this specific scenario, although doing so would obviously accelerate your results. Diversification is the name of the game here. Instead of putting all your eggs in one basket, we are spreading that $10,000 across 4 distinct areas of the economy. Each fund in this setup plays a specific role. One is for growth, one is for global reach, one is for stability, and one is for compounding through dividends. By the end of this, you will see how these 4 pillars create a foundation that can withstand almost any economic storm. The first fund in our lineup is the Core Growth Engine, the backbone of your entire wealth building journey. This is typically a total market or S&P 500 style fund, such as the Fidelity Total Market Index Fund. This fund is designed to give you exposure to the entire US stock market. When you own this, you own a piece of the biggest companies in the world, names like Apple, Microsoft, Amazon, and Alphabet, along with thousands of smaller, fast-growing businesses. This fund is the primary driver of your returns because it captures the innovation and productivity of the American economy. Historically, the US stock market has shown incredible resilience, recovering from every recession and hitting new highs over the long run. By making this the largest portion of your $10,000, you are betting on the collective success of thousands of corporations. It is the ultimate insurance policy against the failure of any single company. Next, we need to look beyond our own borders with the second fund, the Global Expansion Play. Many investors suffer from a US-only bias, thinking that the American market is the only place to grow money. However, a significant portion of the world's economic growth happens outside the United States. By including a Fidelity International Index Fund, you are gaining exposure to developed and emerging markets across Europe, Asia, and beyond. This fund is crucial because there are periods where international stocks outperform US stocks. Global diversification matters because it smooths out your returns over time. When the US economy slows down, another part of the world might be booming. Most people avoid international funds because they feel less familiar, but that is a mistake that limits your potential. International exposure ensures you aren't over-leveraged in one single currency or one single geopolitical region. While growth is exciting, we also need a shield, which brings us to our third fund, the Stability and Downside Protector. This is a bond or total bond market fund. In a world obsessed with 100% gains, bonds often don't make the headlines because they aren't flashy. But this fund is the anchor of your portfolio. When the stock market gets volatile and prices start to swing wildly, bonds tend to be much more stable. They provide a psychological cushion that prevents you from panicking. If your entire $10,000 was in aggressive stocks and the market dropped 30%, you might be tempted to sell everything. Having a portion in a bond fund reduces that total drop, keeping you in the game. It's not just about about the financial protection, it's about the emotional reassurance that allows you to keep a cool head when everyone else is losing theirs. The fourth and final fund is what I call the silent compounding booster. For this, we look toward a fund focused on dividends or low volatility, high quality stocks. Think of this as the fuel for your compounding engine. Dividend-focused funds invest in companies that have a history of paying out a portion of their earnings to shareholders. When you reinvest those dividends back into the fund, you are essentially buying more shares for free. Over a period of 10, 20, or 30 years, this creates a massive snowball effect. This fund adds a layer of consistent cash flow to your portfolio that accelerates growth even when the stock market is flat. Reaffirming dividends is one of the most powerful ways to change your final numbers dramatically without having to find extra money to invest. Now let's talk about the exact allocation for your $10,000. For a balanced long-term approach, you might consider putting 50% into the total market fund, 20% into the international fund, 20% into the dividend booster, and 10% into the bond shield. This 50-20-20-10 split creates a powerhouse balance that works across both bull and bear markets. It gives you maximum exposure to US growth, a solid foot in the global door, a compounding accelerator, and a safety net to keep you grounded. The beauty of this setup is its simplicity. This is a 1-hour task that can work for you for decades. You don't need to be a financial genius to manage this. You just need the discipline to let the allocation do its job. So what could this $10,000 actually become over time? This is where the visualization of wealth becomes real. If we assume an average annual return of 7% to 10%, which is consistent with historical market averages, your money begins to double every 7 to 10 years. After 10 years, your $10,000 could grow to roughly $26,000. After 20 years, that same $10,000 could potentially reach $67,000. And after 30 years, you could be looking at nearly $175,000 or more, all from a single, one-time investment. This is the miracle of compounding. It isn't about hype or getting lucky. It is about the mathematical reality of time and consistency. Imagine what that money represents: a more comfortable retirement, the freedom to switch careers, or a significant reduction in financial stress for your family. Even the greatest Fidelity index funds cannot save you from yourself. Investor error destroys this strategy, not the market. The biggest wealth destroyer is panic selling. When the news cycle is scary and the market drops, many save what they have by selling. They are simply locking in losses and missing the inevitable comeback. Frequent fund change is another mistake. A fund performs well for a year, so many move all their money there, buying high and selling low. Performance pursuit is futile. Discipline always trumps intelligence to win. Staying out of the way is the key to success. This technique is ideal for beginners who want to start strong, busy professionals who don't have time to read the news, and long-term thinkers who value security above excitement. Day traders, get-rich-quick seekers, and those who require their money returned in 6 months should avoid it. This $10,000 investment takes a mindset change. Start seeing your portfolio as a growing forest instead of a gambling account. You don't dig up a tree every week to check its roots. Plant it in excellent soil, water it, and let time do the work. Wealth is built by consistency, not brilliance. You decide. Would you invest $10,000 in a proven system or let inflation erode it in a savings account? The decision to invest in high-quality index funds is one of the most important for your future. Take charge and let the global economy work for you. If this basic investing technique makes sense, like and subscribe for more realistic wealth strategies that work in the real world. Next, I'll show you what happens to these numbers when you add $300 a month to this setup. The results will surprise you. Build your financial future intentionally.